Let's talk about the One Big Beautiful Bill Act, which we will call the O3BA for short. It's a pretty big tax overhaul and will reshape how people think about business planning, charitable giving, and even retirement. There's a lot packed into this bill, but today I'm breaking down the 5 changes that actually matter for business owners, real estate investors, and families planning for 2025 and beyond. In aviation, a waypoint is where you adjust course to stay on track. In financial planning, we call those critical financial events. I created this channel so that no matter what life throws at you, you can maintain the vision to see beyond the waypoint. Let's start with the headline everyone's talking about. The O3BA restores 100% bonus depreciation for qualified properties placed in service January 20th, 2025. This is a big win for business owners, investors, and entrepreneurs. Bonus depreciation allows you to fully expense qualifying assets, things like machinery, vehicles, and office equipment, in the year they're purchased instead of spreading those deductions out over several years. It also applies to many leasehold improvements, land improvements, and certain components of real estate identified through a cost segregation study. That means even real estate investors can benefit when acquiring or improving properties that have short-lived assets like appliances, flooring, and landscaping. But remember, this isn't free money. Bonus depreciation is about timing, not avoidance. It lets you accelerate deductions into high income years to manage cash flow and reduce immediate tax liability. You're not avoiding taxes altogether, you're deferring them by pulling future depreciation forward. But for business owners, this brings back a powerful tool for managing taxable income year to year, especially when planning major purchases or expansions. For real estate investors, it adds back the benefit of doing a cost segregation study on your actively managed investment properties, allowing you to accelerate deductions on the components that wear out faster. Number 2, the Qualified Business Income Deduction, or QBI. This is one of the most misunderstood sections of the tax code, but it also is one of the most valuable for business owners. Here's a quick version. The QBI deduction lets owners of pass-through businesses like sole proprietorships, partnerships, and S-corps deduct up to 20% of their qualified business income from their taxable income. But not every business qualifies. W-2 employees don't get the deduction, and certain service-based businesses like law, accounting, consulting, or financial services can see their deductions phase out once income gets too high. The rules differ depending on how your business is structured. If you're a sole proprietor, the deduction is based on your net business income after expenses, but before your standard or itemized deductions, and it's reported directly on your personal return. There's no formal payroll, and the deduction amount is limited by how much profit the business shows on year end. If you're an S-corp, it works differently. The IRS requires that you pay yourself a reasonable salary, which counts as W-2 wages and doesn't qualify for QBI, but the remaining profit, the part distributed as a dividend, does qualify for the deduction. That setup can slightly reduce your QBI deduction, but it also helps reduce self-employment taxes since you're not paying Social Security and Medicare tax on your distributions. So it's a balance, a smaller deduction, but often a lower overall tax bill. The O3BA extends this deduction and clarifies the income thresholds and phaseouts that made planning confusing for high-income earners and service-based businesses. Number 3, charitable giving. This one's a big deal, especially for families and high-income earners who like to give. The O3BA keeps the 60% of AGI limit for cash donations and makes that rule permanent while improving carry-forwards for unused deductions. But starting in 2026, there's a new twist, a 0.5% AGI floor for charitable deductions. That means you must give at least 0.5% of your income before your charitable deductions start counting toward your tax benefit. So if you earn $1 million, the first $5,000 of giving doesn't reduce your taxable income. Everything above that threshold does. High-income taxpayers also face a new 35% cap on the per dollar tax benefit of charitable deductions. That starts in 2026. That's even if they are in the 37% tax bracket. So what does that mean? You make money at the 37% tax rate, you donate at a 35% deduction, and you're still on the hook for 2% taxes on the amount. On the flip side, for people who don't itemize, a universal charitable deduction is coming back. Up to $1,000 for individuals and $2,000 for couples filing jointly. This means you you can still realize the tax benefit of charitable giving while also taking the standard deduction. So the result, large donors will want to bunch their giving or fund donor advice funds in higher income years to clear the 0.5% floor, while smaller donors can still claim limited deductions even without itemizing. Bottom line, charitable giving remains a cornerstone of good planning, but it now requires a little more intention to maximize the impact. Number 4, the new senior deduction. Those age 65 and older already receive an additional standard deduction under existing law, and that did not go away. In 2025, that extra deduction is $1,600 per spouse for those filing jointly. With the O3BA, those 65 and older will get an additional deduction, which is up to $6,000 per eligible person or $12,000 per couple, available from 2025 through 2028. It begins to phase out starting at $150,000 of modified adjusted gross income and applies whether you take the standard deduction or itemize. This new deduction stacks on top of what retirees already get, giving seniors a meaningful boost in their after-tax income and helping offset higher living and Medicare costs or medical costs in retirement. For a married couple filing jointly in 2025, both 65 and older, the standard deduction would look like this. $31,500 is your base standard deduction, plus $3,200 additional standard deduction, plus $12,000 for a bonus deduction, which comes to $46,700 in total deductions before phaseouts. It's worth noting this is widely seen as a compromise to proposals that aim to make Social Security benefits tax-free. Instead of removing the tax on benefits altogether, Congress chose to raise the deduction for seniors, which still lowers the overall tax burden without changing how Social Security is taxed. Now, this doesn't just benefit retirees taking Social Security, it also helps those 65 and older who haven't started their benefit yet, giving them a tax break without having to take Social Security. And number 5, the SALT deduction. One of the biggest and most talked about updates in the O3BA is the change to the state and local tax deduction, or SALT deduction for short. Since 2018, taxpayers have been limited to deducting just $10,000 of combined state and local taxes. That cap hit homeowners and high-income earners hard, particularly in states with high income tax. The O3BA now doubles that cap to $20,000 for single filers and $40,000 for married couples filing jointly, starting in 2025. And it's now indexed to inflation, so it won't stay frozen like before. But here's the important part. The higher deduction phases out once income rises over $500,000 of modified adjusted gross income. Once you cross that threshold, the expanded SALT deduction is reduced by 30% of the amount your income exceeds $500,000 until it eventually levels back down to the old $10,000 cap. So the full benefit applies mostly to middle and upper middle income taxpayers who itemize but aren't in the ultra high income bracket. For married couples, this also removes the so-called marriage penalty under the old $10,000 cap. And for business owners, the O3BA makes the pass-through entity tax workaround permanent, letting certain S-corps, partnerships, and LLCs deduct state taxes at the entity level rather than losing that deduction on their personal returns. In short, the new SALT rule provides meaningful relief to many taxpayers who felt boxed in by the old limit while phasing out benefits for households with incomes above $500,000 to keep things balanced. Those are the 5 biggest O3BA changes. There are several other updates worth noting, some new and some simply extending what's already been in place. A few of the more attention-grabbing additions include tax-free overtime, no federal tax on tips, opportunity zones made permanent, and the new Trump accounts. Other changes were big in scope, mainly extending existing provisions that were set to expire, but most taxpayers won't fill those because they've already been filing under those rules for the last several years. In other words, the O3BA didn't just add new opportunities, it prevented a lot of tax increases that would have quietly kicked in without it. Not all flights will be without turbulence, so it's important to make adjustments when needed. Like and subscribe for more videos on how we support clients in their financial journey, helping them see beyond the waypoint.